December 20th, 2024. A trade panel ruling reshapes U.S.-Mexico corn forever. February 6th, 2025. Mexico lifts its GMO corn ban and shipments roll again. This isn't a collapse, it's a reset, and the real battle is just beginning. Historical context and lessons learned. In 1994, the North American Free Trade Agreement, NAFTA, opened a new era for U.S. corn. Tariffs dropped, trade surged, and Mexico quickly became America's largest export market for grain. But that partnership was tested in 2013. A dispute over pesticide residue limits slowed shipments and sparked months of contract uncertainty. While the issue was eventually resolved, it revealed how quickly technical regulations could disrupt a billion-dollar supply chain. Then came 2023. Mexico announced restrictions on genetically modified corn for human consumption, citing health and environmental concerns. For U.S. farmers, it was a direct threat to a market worth billions in annual sales. For Mexican importers, it meant scrambling to secure enough supply for tortillas, feed, and industry. Fast forward to December 20th, 2024. A USMCA dispute panel sided with the United States, rejecting Mexico's GMO limits as inconsistent with trade commitments. Just weeks later, on February 6, 2025, Mexico officially lifted its ban, reopening the door to U.S. corn under clearer, more predictable rules. The lesson is simple, but critical. Trade relationships are never static. Even trusted partners can change the rules overnight. Long-term success depends not only on price and yield, but also on resilience, adaptability, and the ability to meet shifting political and regulatory demands. For U.S. corn, history shows that the strongest players aren't just the cheapest suppliers, they're the ones prepared for the next surprise. The market reset. This was never a collapse. It was a reset. The USMCA ruling didn't create new demand overnight, but it replaced uncertainty with structure. For U.S. farmers, that means shipping to Mexico without the shadow of sudden bans. For Mexican buyers, it means planning feed, tortilla, and industrial starch production with confidence. Trade flows are back, but they're moving under clearer rules, tighter contracts, and more predictable timelines. In today's market, that predictability is as valuable as price, and it's reshaping how both sides measure trust and risk in the corn trade. Price versus cost. The margin squeeze. As of August 8, 2025, U.S. corn futures on the Chicago Board of Trade are trading between $3.83 and $4.06 per bushel. That's well below the break-even price for many Midwest farmers, which sits between $4.60 and $4.66 per bushel, according to the 2025 Illinois Extension budgets. Every bushel sold on the open market could mean a loss of 54 to 77 cents, before any government support, crop insurance payouts, or premium contracts. And that's just the futures market. Local cash prices are determined by the basis, the difference between the futures price and the price offered at a specific location. When freight costs rise or export demand dips, that basis weakens, pulling cash prices even lower. A typical P&L waterfall for a bushel of corn today might look like this: futures price, minus basis adjustment, minus freight charges, minus compliance and inspection fees, net farm gate price. In this environment, yield alone isn't enough to stay profitable. Margins depend on securing premiums for identity-preserved or non-GMO corn, reducing input costs and timing sales to capture stronger basis levels. For U.S. corn producers, the real challenge in 2025 is not how much they grow, but how, where, and to whom they can sell without watching their margins evaporate. The Cost Stack 2025. In 2025, every layer of the supply chain is feeling the pinch, and it starts well before a bushel leaves the farm. First, Section 301 tariffs on ships built in China. Designed to boost U.S. shipbuilding, these fees add cost for exporters relying on foreign-built vessels. Even a small percentage increase in vessel operating costs ripples through freight rates to the buyer. Second, proposed tariffs on port cranes. Many major U.S. terminals depend on equipment sourced from the same global supply chains. If these tariffs take effect, unloading costs rise and terminal efficiency could suffer, adding both expense and delay. Third, the Mississippi River bottleneck. For the third consecutive year, low water levels are reducing barge capacity, forcing lighter loads and longer transit times. During peak congestion, barge freight rates have surged more than $20 per ton, eroding Midwest basis values. Fourth, compliance, ESG, and traceability requirements. Buyers in Mexico, Asia, and Europe are demanding stricter pesticide residue limits, documented sustainability practices, and full traceability from seed to shipment. These aren't optional for premium markets, and even bulk buyers are adopting them as baseline requirements. When you layer these costs together, the landed cost, the total price to deliver corn to the buyer's port, climbs sharply. A competitive futures price can still lose the sale if the landed cost overshoots rival origins like Brazil or Argentina. In 2025, winning the deal means mastering the entire cost stack, from vessel tariffs to river depths, and finding ways to trim each layer without sacrificing reliability. Mexico. Anchor, not a crutch. Mexico remains the single largest buyer of U.S. corn, taking in over 23 million metric tons in the 2023-24 marketing year. The USMCA ruling and the February 2025 policy change restored confidence for both sides, allowing long-term contracts to move forward without fear of sudden GMO restrictions. Most shipments flow by rail from the Midwest directly into Mexican feed mills and food processors, while barge-to-Gulf routes handle a smaller share for southern ports. This integrated logistics network makes Mexico a stable anchor for U.S. exports. But stability doesn't mean immunity. Rising freight costs, tighter import standards, or currency swings can still chip away at competitiveness. For U.S. exporters, Mexico should be a foundation to build on, not a crutch to lean on. Relying too heavily on one market, no matter how reliable, leaves the supply chain exposed when the next shock arrives. Competition map. Canada versus BRICS. On the northern front, Canada has carved out a strong position in premium markets. Its edge comes from non-GMO production, strict traceability systems, and the ability to meet the high regulatory standards of the European Union, Japan, and South Korea. These buyers are willing to pay a premium for shipments with full documentation, identity-preserved grain, and verifiable sustainability credentials. However, these premium sales represent niche volumes, valuable for margins, but far smaller than the bulk feed corn trade that drives Mexico's market. On the southern front, Brazil and Argentina remain the heavyweights in bulk competition. They leverage lower production costs, favorable exchange rates, and increasingly efficient ports to push large volumes into Asia and the Middle East. Brazil's safrinha crop, harvested later in the year, often hits the market when U.S. supplies are tightening, giving it a seasonal advantage. Argentina, while smaller in volume, benefits from flexible shipping windows and aggressive pricing strategies. When freight costs from the U.S. rise, whether from Section 301 tariffs, port crane fees, or Mississippi bottlenecks, importers start calculating the total landed cost. If Brazil or Argentina can deliver within acceptable timeframes at a lower landed price, even long-term U.S. buyers may shift part of their contracts south. In today's corn trade, the competitive map isn't drawn by distance alone. It's shaped by timing, cost structure, and the ability to match the buyer's exact needs at the right moment. Case study: Traceability that pays. In Ontario, a pilot project called Grain Discovery is showing how technology can turn compliance into profit. The platform uses blockchain to log every step of the grain's journey, from seed variety and field location to fertilizer use, harvest date, storage, and final transport route. For certain buyers in Japan and South Korea, this level of transparency is no longer optional. It's a procurement requirement. When combined with carbon tracking, which records emissions from farm to port, shipments can qualify for premium markets in the non-GMO and low-carbon segments. The difference shows up in the price. Standard feed corn might sell at a flat basis, but identity-preserved, fully traceable non-GMO corn can earn an extra 30 to 50 cents per bushel, depending on market conditions. For farmers, that can turn a marginal sale into a profitable one. For exporters, it means securing longer-term contracts with lower rejection risk. However, this remains a niche channel. It doesn't replace the massive bulk trade to Mexico or the Middle East, but it can act as a high-margin supplement to diversify income streams. As global buyers demand more proof of origin and sustainability, programs like Grain Discovery could shift from nice to have to must have for exporters chasing premium contracts. Scenarios 6 to 12 months. Over the next year, the U.S. corn market could follow one of three primary paths, each shaped by logistics, weather, and global competition. Bull scenario, approximately 30% probability. Mississippi River water levels improve, easing barge congestion and lowering freight costs. Proposed tariffs on port cranes are delayed or dropped, keeping landed costs competitive. Strong Mexican demand combines with steady premium sales to Japan, South Korea, and the EU. Result: Midwest basis strengthens, net farm gate prices rise, and exporters regain margin without sacrificing volume. Base scenario, approximately 50% probability. Freight costs remain elevated but manageable, as some river bottlenecks persist. Tariffs on port equipment are implemented partially, adding modest cost pressure. Mexico holds steady as the anchor market, while premium channels grow slowly. Result: prices stay under break-even for many farmers, forcing efficiency gains and selective premium targeting to maintain profitability. Bear scenario, approximately 20% probability. Low water on the Mississippi continues for a fourth year, driving barge rates to new highs. Full port crane tariffs take effect, compounding ocean freight expenses. A mild La Niña trims North American yields, while Brazil and Argentina bring strong crops to market. Result: higher landed costs and seasonal BRAR competition erode U.S. share in Asia, and even some Mexican contracts shift south. The takeaway? In 2025 to 2026, success won't hinge on a single factor like price or yield. It will depend on managing a mix of logistics, compliance, and market timing, and being ready to pivot when one of these scenarios starts to play out. Exporter Playbook. For U.S. farmers and grain exporters, 2025 demands more than just a good harvest. It demands strategic positioning. 1. Target premium channels where possible, secure identity-preserved or non-GMO contracts with buyers in Japan, South Korea, and the EU. These markets pay a reliability premium for traceable, compliant shipments. 2. Manage basis. Proactively monitor local basis trends and hedge or forward contract sales when basis levels are favorable. Strong basis can offset low futures prices, especially during seasonal freight bottlenecks. Third, time sales. Around the safrinha window, Brazil's second corn crop often shifts global demand in late Q2 and early Q3. Plan export offers before this supply wave hits key markets. Fourth, lock in delivery clauses. Negotiate clear terms for on-time delivery, demurrage penalties, and inspection service level agreements, SLAs. Reducing delivery risk strengthens your reliability premium. 5. Streamline compliance. Maintain updated pesticide residue records, carbon tracking data, and ESG documentation. Quick turnaround on compliance checks can be the difference between winning or losing a sale. In today's corn market, volume alone won't keep you in the game. Winning requires a mix of market intelligence, timing, and operational discipline, ensuring every bushel you sell lands in the right market, at the right time, with the right paperwork in place. 5 signals to watch. If you want to track where the U.S. corn market is heading without getting buried in market jargon, focus on these 5 indicators and check them regularly. 1. USDA weekly export sales. Watch volumes for Mexico, Japan, and South Korea. Source: USDA Foreign Agricultural Service reports, updated every Thursday. Second, barge freight rates and Mississippi River levels. Low water means lighter loads, slower transit, and higher costs. Source: USDA Grain Transportation Report and U.S. Army Corps of Engineers River Stage Data. Third, Section 301 and Port Crane Tariff updates. Even a small change in these policies can ripple through ocean freight costs. Source: U.S. Trade Representative announcements and Federal Register notices. Fourth West Report, monthly data on production, demand, and ending stocks for 2025-26. Source: USDA World Agricultural Supply and Demand Estimates. 5. Ontario versus Midwest basis. A stronger Canadian basis can signal real trade wins or just niche premium sales. Source: Provincial Grain Marketing Boards and CME Group cash bids. By keeping these 5 markers on your dashboard, you'll see market shifts as they happen, and you'll know whether U.S. corn is holding its ground or quietly losing it. Trump tariffs. 2025 haven't erased the U.S. corn market. They've reshaped it. Mexico remains the anchor buyer, but costs, compliance, and global competition are redrawing the map. In this environment, winning isn't about being the cheapest. It's about being competitive on price, reliable on delivery, and spotless on documentation. So here's the question. In 2026, which factor will decide who wins? Freight costs, seasonal timing, or buyer trust? Drop your thoughts in the comments. And stay tuned. In our next episode, we'll break down how freight repricing can shift basis across every U.S. region.